All right. Now moving on swiftly, the global economy has been on a recovering trajectory, though the challenges occasioned by the Russia-Ukraine war and a rising inflation still raises major concerns. I spoke to Birju Sangaraka, head of commercial, corporate and institutional banking at Standard Chartered, and started by asking him whether Kenya has been on such a tight spot before.
If you go back to the 2000s, Kenya had a debt to GDP in the 60s ratio, and we managed to bring that down to 38. Now, albeit the world is in a very different place today. So if you think about global challenges, so whether it's the Russia-Ukraine war, and some of the challenges of inflation being imported by rising U.S. interest rates, and then you couple it with the drought situation that you just talked about. It's a pretty tough place that Kenya is in. But given the circumstances, we think that the actions being taken are apt, and the glide path, and if we're looking for instant results, you will not see it, but the glide path should get us to that place where we want to in terms of fiscal consolidation, trying to lessen the debt load. So we generally think that despite all the challenges, it may take us a little longer, but the glide path is in the right trajectory right now.
Definitely. And we look at global, institutions and, the way they are assessing the risk in this particular market in the sub-Saharan Africa. Just recently we saw the S&P, sort of downgrading our rating in regards to debt risk. And this does not only affect Kenya, quite a number of sub-Saharan African countries and globally. Everyone, the risks are up there, debt risk. Talk to me about how we gonna mitigate this. I know you've talked about fiscal consolidation. It seems we have a very small fiscal room to operate based on how the government has been handling issues.
You're absolutely right. But think about it this way. In terms of our debt service, between now and 2020, in the next 2 years, let's put it that way, we've got about $8.2 billion of foreign debt service. The number in itself looks very scary, but every year we comfortably do $3 billion. So $3 billion last year, $3 billion this fiscal year. So the difference, the 3 and 3 every year, the $2 billion is actually your 2024 Eurobonds, which are due for repayment in June next year. The worry, and you talked about the S&P changing its outlook. They didn't downgrade Kenya, let's be clear on this. They changed the outlook to negative. One of the key reasons was this big debt repayment that is due next June. You look at it historically, in the last 12 months, the narrative has been emerging markets have been closed for issuers like Kenya to tap the Eurobond markets. And that is true. However, if you've seen since the beginning of the year, we've started seeing emerging markets, some in Asia, already starting to issue. We do believe that there is investor appetite for Kenya because we see it and we're talking to investors out there. And we do think that in H2 this year would be a good time for Kenya to come back to the market. So well before the June 2024 Eurobond repayment.
Okay. And we've seen now Reliance coming back to the local market. Initially, we saw a huge appetite for the bonds. Then that has slowly declined again. So people are going for T-bills, short-term papers. Talk to me about that change of attitude. What was informing that, and is it something that's going to persist?
Well, there's a view that to tame inflation, you need to raise rates. And the US has done it quite successfully. We'll see towards the end of this year if actually that comes true. With Kenya's rising inflation, our rates did creep up slightly. We saw some interest. But then when the inflation started tempering, we saw it in December and January come down slightly. February it went up by 20 basis points. But broadly speaking, it also necessitated us not to continue raising rate. If you remember, the central bank raised its CBR late last year, but didn't do it in the last MPC. And that's a reflection of where they see the tempering of the inflation rate. Now, the question would be for anyone is, where do you think inflation is going to end up? And is there going to be a need to raise rates? To keep their powder dry, most people are going into the short end of the market right now, and in the hope or in the expectation that if inflation goes up, rates will need to go up, and it'll allow them to quickly get into more better yielding paper. But the question really is, where do you think inflation is going to go
Okay. So all this is pegged on inflation. I was listening to the president earlier on, especially those formative days of very high, coupon rates for, the bonds. And you're saying this is just too ridiculous, 13% and whatnot. And the aim was to reduce that and to bring it down. I don't know, coming from the government perspective, was that the right outlook by His Excellency?
That's a difficult one. I mean, you'll have to ask His Excellency the answer to that. Frankly, but I think directionally, lower interest rates means better economic development for the country. More people have money in their pockets, and you can get economy going. So directionally, lower interest rates makes complete sense.
Okay. And now we are looking, we are entering now, we're almost doing the first quarter of the year 2023. A lot of, bullish outlook, even in the markets. Talk to me about what you're expecting to see. You talked about some of the emerging markets in Asia, for example, now coming back, issuing the Eurobonds. For Sub-Saharan Africa, what should we be expecting?
Our story remains the same, because what we do as Standard Chartered really well is we connect capital. So connecting capital from the markets that we operate in, Asia, Africa, Middle East, Europe and Americas, to opportunities on the ground. We have been speaking to investors over the last 12, 18 months, and we continuously speak to them. There remains a positive story in Sub-Saharan Africa. The challenges, as we've seen in West Africa, more recently, South Africa is going through its own challenges. But if you look at portfolio flows, and you've got to dissect portfolio flows, those that are hot, that come in to invest in the stock market, in the equities market, that come in on a short-term basis, which are necessary for the country, from patient capital that is coming in to spend 3, 5, 10 years and see out any development cycle. So when we're talking to investors, and we're seeing more investors now talking about more patient capital, we're seeing a lot more interest in coming in for a long-term view. Now, the question you've got to take is do you see Kenya riding out the challenges? Do you see Sub-Saharan Africa riding out its challenges? I think the answer is yes.
Indeed, very, very positive outlook and hopeful. Thank you very much for joining with us in Business Today. I'm Lokip Kimbo. Up next, you have KTN. Stay tuned.